Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 423. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the what are you listening to? The internet's favorite podcast. That's what you're listening to. About apparently maximizing your income.
Just the internet's favorite podcast. That's all.
Yeah. Well, hey, we try.
The rest of the world just hasn't figured out that it's the internet's favorite podcast yet, but they're coming around.
If you know, you know.
That's right. Tell a friend. Or just tell someone that you don't want to talk to you ever again, and then they'll listen to us and they'll be like, I don't know why that person told us to listen to that, but they're weird, so.
Done with them.
Yeah.
But then they'll come back to us for more episodes.
Yeah.
Because there's a strange guilty pleasure.
So has this gone from the Insurance Pro Blog podcast to the Income Professionals podcast?
Do you want it to?
See what I did there?
Do you want it to? Yes. I see that.
Seems like that's what we talk about all the time now.
Well,
I think we're just excited that the rest of the world is coming around to something we've been saying for like, well, how long have we been doing this? 13 years? Something like that?
A little while.
Almost.
Yep. The thinly veiled secret about the Insurance Pro Blog is that it was really all about pointing out the income capabilities of life insurance from the inception.
We probably could have done a better job of just saying that.
We could have. But, 24-ish year old Brandon was different, and he had this different idea about what to do and how to do it. So, here we are.
I think we were both a little bit naive to the fact that, well, people have figured it out themselves if we just present the information.
Yeah.
Turns out, some people did figure it out for sure.
They did. Some people thought it was all about infinite banking, which was never about that. But
that's true. That is true.
It does come up.
Yep.
Which is fine. So today, income is the topic on the table, and specifically guaranteed income. And we teased this at the end of last week's episode. So this is research recently published by the American Society of Pension Professionals and Actuaries.
The ASPPA.
And the excitement has reached a fever pitch when I rolled that one out.
Next thing you know, they're going to have Sarah McLachlan doing their commercial. There's 3 people who will get that. Obscure references. My apologies. Sorry, I couldn't help it. We've lost Brandon. He's gone.
I'm here. So this research shows us that Americans look at their retirement assets differently depending on what they bring to the table and how they function. So basically, they segment them into 2 categories.
Mm-hmm.
Assets that are accumulated through savings in something like a defined contribution plan, think 401k.
Right.
Versus assets that are specifically designed to create income, guaranteed income.
Right.
And it turns out that Americans are very willing to take guaranteed income assets and spend them.
Yep.
They're very unwilling to take saved assets and spend that.
It's genius, really. Well, I mean, I didn't say who the genius was, but the investment industry convincing people they shouldn't spend their savings.
Well, yes, there is that.
Yeah, it is funny though when I was looking at this and I thought about it, I was like, yeah, that's true. No one hesitates to spend their monthly Social Security benefit or any pension income that they get.
Nope. We've seen this.
Nobody's going like, I got to save 50% of my Social Security.
Nope. This matches our experience.
Yeah, it's perfectly. That's probably why when we saw it, we're like, we got to talk about this. Someone proved us right.
Here's some confirmation bias of something we've got going on, so we're going to talk about it. No, but from the numbers here, on average, people spent 80% of the lifetime income that they were generating. So this could be Social Security, could be pension, could be annuity income.
Right.
Like they were indiscriminate.
Sure.
It didn't care where it came from. If it were guaranteed income, very willing to spend it.
Right. It feels the same.
Yep.
I mean,
savings in like 401k IRA type assets, 2% is the withdrawal rate.
well, if you believe in the 4% rule, then people
The
are doing
2%
okay.
rule must be something better but worse.
Right. It is fascinating.
And like very, very conscious reluctance to spend money saved in 401k. And here's the interesting kicker in all of this. The reason for not spending the money rarely had anything to do with inheritance, legacy. It's not about leaving the money behind. It's about the paralyzing fear of running out of money.
Mm-hmm. It's about taking too. Am I taking too much?
Yep.
And even further, and I believe, I'm going from memory here. There's a reluctance as well because it's like, well, what do I sell?
Yep.
Like, if this is in my IRA, which used to be my 401k that I rolled over, like what do I sell to meet said income need?
Mm-hmm.
That's very difficult for people.
Now,
and this tracks with our experience. I mean, 100%.
Mm-hmm. Yes, it does. Now, the issue is quite complex because there's a lot of different consequences of the decision or the decisions that retirees are making regarding their assets.
Mm-hmm.
And the research here points out that there is a pretty healthy amount of underconsumption that's taking place. And it's not necessarily in the context of, well, if we are not going to spend the money in the 401k, for example, that just means we're going to buy the Chef Boyardee instead of the insert name of something that sounds more expensive here for dinner. And it's not
I think
that.
you just gave everyone a little window into your world. Brandon's two favorite dinner options, Chef Boyardee and Cheerios.
Cheerios with bananas, sir. Specifically,
we've classed it up now.
Specifically, the Hearty Cheerios, whatever they are, with the little pumpkin seeds in them. Those are great. Come for the insurance, stay for the food talk.
Hot food talk, or cold. Either way. Yeah, I get what you're saying, though.
This isn't like we're just gonna not do those spendy things. It like there's a lot of sacrifice that's taking place. That Chef Boyardee example was probably a little too heavy-handed because it didn't quite explain. Like this really isn't about we're just going to trade in cars less frequently or we're not going to go on vacations. These are things that are these are decisions
everyday
that are driving
decisions.
Very subdued consumption decisions.
Yeah,
because people are too afraid to spend that other money.
Have you seen the price per pound of bananas lately? I mean, those are the kind of things that people do.
Yep, it is.
It's like, no, I haven't, because I just buy bananas. I don't pay attention to them.
Doesn't seem to be the case that regardless of how many I buy, they never cost more than like $2 for all of them.
Right.
So the point that is made here from the research shows us that one, $1 saved in a 401k is worth about $2 when put into other assets that provide guaranteed income. Again, Social Security, pension, annuity. So in terms of income capacity. So Americans are getting much more value out of the assets that create income for them because they'll actually spend that money.
Right.
Whereas they're not really getting anything out of the assets that are saved in their 401k because they won't spend it. And additionally, the point is made here that it seems attitudinally that people struggle a lot with the transition of saving is good to now spending is good.
Right.
And this is something that we touched on numerous times in the past.
Mm-hmm.
So not new territory for us. We've always found it to be a bit complicated to convince somebody that they should completely reverse the virtues in their life.
Right.
Saving is good, spending is bad. Now spending is good, saving is bad.
Right.
That's got a weird uncomfortableness to it.
It's nigh impossible for people who have spent their life with the attitude that spending is bad because we need to accumulate more.
Yep.
And what we've done with defined contribution plans, 401ks, 403bs, TSPs, 457s, all the same. What we've done is ask people to adopt that mantra their entire life. And then when you retire, you flip a switch and you go the other direction.
Yep.
It just doesn't work that way. I mean, in our experience, in our practice, we do not see people who have overachieved at saving overachieve at spending.
No. And we also have experience, decent amount of experience at this point, working with people who are in retirement, who have various assets, who themselves struggle with the process of spending money that they are completely capable of spending.
Right.
Like it causes zero worry about their financial viability moving forward.
Right.
But they still express great apprehension about spending that money because it is so far removed from the behaviors and the mindset, and even I would argue the perceived discipline that they have regarding money.
Mm-hmm.
And so to transition to a world where they loosen the purse strings, it feels very unnatural.
Yes.
But even those people, to whatever degree they have guaranteed income, again, Social Security, pension, annuities, any of those sources, that money goes away just as quickly as it comes in.
Right.
They don't have a problem with that. And we have advocated for years that people should probably take saved money and look for assets that can provide guaranteed income or close to guaranteed income. Because not every asset that is good at income necessarily has to be guaranteed.
Sure.
And if they do that, they will find themselves in a position where the anxiety that develops over how to spend money is greatly diminished.
Yep. Annuities being one of those things.
Yep. That work extremely well.
Right.
In fact, there's a quote from this that says retirees with assets that annuitize income spend twice as much as retirees with an equal amount of non-annuitized savings. So in other words, you got $100,000 and you choose to buy an annuity with that. The average person in this study would go out and spend twice the amount because of that now guaranteed income.
Yeah.
Than the person who said, I'm just going to withdraw 4%, well, actually 2% of that balance every year.
I think there's the study doesn't go into this, but this is anecdotal observation from years of doing this. There's something deeply embedded in our psychological programming of over our careers of being paid a paycheck every other week, once a month, whatever it was, whatever frequency most people are paid. That it burrows into your psyche.
Yep.
And so, and we've talked about this before, most people who retire have never had to rely on their own war chest to provide them with that paycheck. So they're gripped with fear.
Yeah.
when it comes time to do that.
Nothing prepares them for it. And
No.
sadly, there's very little that prepares advisors
Yeah.
for working with people through that.
Right.
We've got content going back to the beginning of the Insurance Pro blog that pointed out that advisors are really good at building portfolios, primarily for risk mitigation of losses in bad economic times.
Yep.
Generally pretty good at championing the virtues of saving. So trying to talk people out of decisions that would generally be considered bad when economic times get bad.
Over-consuming. Yeah.
Yep. But not all that great at the distribution side.
Right.
Not a lot of advice on that. Not a lot of
hey,
tactic.
You're retired. You've arrived.
Right. And
now go have fun.
What's so baffling to me, and it has gotten more and more baffling as time goes on, and I see more people go through this process, is eventually most of us come to the conclusion that we're only going to live so long.
Right.
And within a certain amount of reason, we can kind of predict roughly how long that is. And given that, there is a certain amount of enjoyment that we probably want to get out of life.
Right.
And so once, especially you get to retirement, in theory, the number of years is becoming fewer and fewer.
Right.
And so the time to take advantage of what you've been able to accumulate is now in a lot of regards.
Yeah.
And
well,
so
it's supposed to be delayed gratification, not deleted gratification.
That's an extremely good point.
It's there. I mean, there's good reason to be frugal, tight, whatever you want to call it. When you're in the accumulation phase of your life, because if you don't need that money to survive, then you should put it away.
Yeah.
But when you're retired, you need that money. So, and you should enjoy yourself. I mean, I think every reasonable person understands the difference between enjoying life and going crazy. We're not advocating going nuts.
Nope.
But, and I think you and I have, in our personal lives, have experienced this miserly attitude follow people well into their retirement and deprive themselves of all sorts of joy. That's just unnecessary.
Yep.
And I don't mean going crazy. Depriving themselves of such things as needed medical care and some assistance, perhaps. At doing things, paying someone to do things that are no longer easy for you to do physically, or perhaps are just not enjoyable. You don't want to. I mean, it's a completely valid reason not to do it.
Or just buying the yogurt you think you'd like more. We've seen it. Okay, we've seen it.
You can buy the name brand Cheerios now. You know? You don't have to buy the toasted oats anymore.
We bring it up in a somewhat
well, you got to laugh about it.
Lighthearted way. Yeah, you do. You just do.
It's sort of sad. So,
and I would be willing to bet there are a number of kind of middle-age-ish people listening to this, thinking about their parents who are probably living this life, kind of rolling their eyes and giggling at the same time.
Right.
Because we see it. And they've experienced it, I'm sure. And we have talked a few times in the past about observing family members and people who we've worked with professionally, and seeing the stark difference between those who have a high degree of guaranteed income.
Yep.
And I don't mean high in terms of like absolute dollars they have more. I just mean that when it comes to the relativeness of what they were earning before, they have guaranteed income that pretty completely matches what they were earning pre-retirement.
Sure.
Versus those who have
especially
very
if you
little
back out some of the expenses they had when they were still working and things like that.
Yep. Versus the people who really don't have much of that going on. They just saved money.
Right.
And the ones who just saved money, like they get the blessings from the financial guru types.
Yeah.
The guy who's got the radio show that we all know, or the lady who has the radio show that we all know. And they would sing high praises among those people who saved all that money.
Right.
And yet those people who did all the things, quote unquote, right, are some of those miserable people we know.
Yeah.
Because they don't spend any money. And they're afraid to.
Yep.
And they don't get to enjoy a lot of the things that they should be able to enjoy, not because they can't, but because they stand in their own way to do it.
Right.
Now, interestingly, we spent a lot of time talking about this sort of mental shift away from saving is good, spending is bad, to now spending is good, saving is bad. Yes, totally. But something else that's eyebrow raising and noteworthy here from the data shows us that RMDs. So when people are forced to take money out of their IRA
right.
through a required minimum distribution, they have no problem spending that money.
Isn't that interesting?
Which to me identifies
it's
the
compulsory
fact that,
spending.
Yeah.
But it's not, because they could save it. But yes.
It identifies the fact that a lot of people are really hung up on the why and how.
Yep.
And again, that's where a lot of the financial planning industry hasn't been super strong.
Yeah.
So people,
and we see, one of the big things we've seen over the years with with qualified money, which would fall under RMDs, is people don't want to spend the money because they'll have to pay taxes.
Yeah.
Like, yeah, but then I'll have to pay more taxes. It's like, but you made money. You'll
have income. You'll have income.
There's a weird thing that taxes do to people's brains.
It does. Yes, it does.
We were talking about that before we started recording, and like, well, I've definitely paid less taxes, but I'd prefer to keep paying somewhere around, where I'm at now or higher, because that means I made more money. So
Yep, it does.
I've had both. I'd prefer the situation I'm in now to the other one.
So from our own experience, we've sold a number of annuities. And we have clients who are currently collecting income from a number of those annuities.
Mm-hmm.
And we also have experience in talking through the process of income from other sources like saved money.
Right.
And interestingly, we have 0 conversations with the people who have annuities that are just paying them income. They don't need to know what to do.
No.
They don't have any questions for us. The insurance company sends them their check. Figuratively, most of the time it's just EFT.
Yeah.
And they go live their life.
Yep. And I would say, if you want to boil it down to the most rudimentary thing, most rudimentary annuity being a SPIA, single premium immediate annuity, where people write a check and they get an income stream. Typically within a month or two, it starts coming in, depending on what they want. There's no discussion. There's no one's ever called and said, I decided I don't need this money.
Right. Yeah. They don't call up looking to give it back.
No. There's no. In fact, most of those people, we have to call them just to talk to them, like, hey, how are things going? Do a review. Yeah, everything's great. Money comes in.
Yep.
Like, there's no.
What happened this week on the market? Don't care.
Unless you've been a part of some conversation I wasn't a part of, I've not had anyone call and say, or heard anyone say, yeah, I really regret doing that.
No, because for there's going to be a small percentage of the population that's going to be unique about this. They might look at the income that they derive from an annuity and say, well, had I kept it here, I'd have this other money. Maybe. But they are a small group of people.
Sure.
Everyone else kind of realizes that they got something of pretty extreme value
Yep.
out of the income that they received from the annuity.
Yep.
And so you can't, in their eyes, buy back those memories with the grandkids, that thing that they were able to do that they'd been waiting to do for a long time. The ease of just having the income that allows them to go live life.
And
that
and not think about
important.
everything all the time.
Yep. I've talked about family before. I've used my own mother as an example. I'll do one right here. So she's got a decent amount of money in an IRA.
So you're saying she's still not listening? Is that what you're saying?
No, I highly doubt it. And assets are very much positioned to provide income. It's not guaranteed income, but it's providing income.
Yeah.
And then also owns annuities.
Mm-hmm.
And income features are turned on.
And that is guaranteed.
That is guaranteed.
Right.
And that comes in every month.
Mm-hmm.
And she figures out a way to spend that money every month, no problem. The money that's in the IRA, we have conversations weekly.
Right.
About whether or not that's, I probably should stop spending the money. And it's fine.
Right. I remember you telling me an example about her looking at something nice that she never,
Yep.
would never buy normally. And you happened to be with her and she was like,
Yep.
I really like that. And you're like, buy it.
Mm-hmm.
Oh, I don't know if I should.
It was a handbag.
Right. There's a lot of...
I know that we've got a fairly male-dominated audience, so everyone's going to be like, oh, okay.
Yeah, but everyone has a mother, so they can understand.
But it's a handbag. I don't remember, a couple $100.
Yeah.
Like $400 or $500. That she was looking at going, I really like it, but I don't know. And there's plenty of income that came in this month.
If you want it, buy it.
Just buy it.
Yeah.
She's certainly not one foot in the grave at this point, I don't think. But you're definitely at a point where there are fewer years in front of you than behind you.
Sure.
So you got the money, do it and enjoy it.
Right.
Because it's not going to make any difference. This purchase or even 5 more like it.
Sure.
Over the course of the next year are not going to be the reason you go bankrupt if that were to happen.
Right. You did all the right things for decades, so enjoy yourself a little bit. It's okay.
Yep. But again, if it came from the annuity,
it wouldn't have even been a discussion. The other money only came into play because all the money from the annuity was gone already. In all likelihood. Yeah, it is interesting. We've talked about some people we've known who, or maybe one of your other family members, someone who's passed away now, who had a pension and a small annuity or something like that. Didn't have a whole lot of other money per se, but man, they were happy.
Yep.
Had more than enough to do what they wanted to do. And
actually both my wife and I have grandparents that old enough so that they had pensions that were quite healthy.
Yeah.
And then Social Security income, and didn't come from a generation that was obsessed with saving money in 401ks, so didn't really do that at all.
Right.
And so if you looked at them from an assets accumulated standpoint, they didn't look all that well off. But they're some of the happiest people I've ever met in my life.
Yep.
Because money came in every month.
Yep.
They knew what budget they were operating within, and everything was fine.
First of the month, there's more money coming. So
if you were to hand them a TV remote and say, okay, get me to CNBC, we'd be a while as they were flipping through the channels trying to find it.
They knew what time The Price is Right came on, though.
Yes, they did.
And we're not suggesting that should be your life, but we're just using the story to illustrate that having some sources of guaranteed income, again, like Brandon said, it doesn't all need to be necessarily. That really depends on your preference, but having some, this research proves changes behavior and leads to a better quality of life in retirement.
Yep, it does. Look, if you set yourself up in this fashion, you can be a little naughty with your money.
Yeah.
And it turns out that can be kind of fun.
Yes. Yes, it can.
So, income should be the focus. That's where people should really start to think tactically. And annuities are one of them. They're not the only one. They tend to shine. They shine brightly here because they're an example of guaranteed income where people spend more money. Right. So helps, or it's somewhat obvious that this is coming from the American Society of Pension Professionals and Actuaries. So what do you know? They have a certain bend towards annuities.
Sure.
But it's correct. Like,
yeah.
Social Security and pensions are two things that you can be part of, but you don't have tons of control over.
Yep.
Annuities are a way that every individual can create guaranteed income for themselves.
Absolutely.
You have more control over that scenario.
And I will say, I think I speak for both of us, the people that we know, that we work with who are income focused. I'm not saying they have everything in guaranteed income, but I'm just saying they focus all of their assets toward income generation. Or at least that's what their thought process is. No panicked phone calls in the last month about what their portfolios are worth or...
Nope. And in general, wildly more successful at obtaining their retirement goals.
Yep.
Because they knew where they were going.
Exactly. It wasn't about hitting some arbitrary account balance.
Right. Which means practically nothing to most people.
Yeah, exactly.
Okay. Good enough for today.
All right.
I am Brandon Roberts.
And I'm Brantley Whitley.
And we will see you next week.